Last year, tech sector performed very badly. Tech stocks fell more than 30% in 2022, more than the overall market drop of 20%. In this video, I'll explain why tech suffered so much, what their new reports say, and which of these companies are cheap to buy in the dip now. 2022 was the first year the Nasdaq saw 4 quarters of drop in values. It was the third worst year for tech after 2008 and the burst of the dot-com bubble in 2000. Major players in the world of tech saw huge losses. Meta lost 2/3 of its value, and Tesla saw similar drops. Amazon also lost half of its value. But why did they fall? Tech stocks fell because the Federal Reserve started raising interest rates. Tech companies and startups relied on the cheap money that interest rates of almost 0% provided. As the rates rose, investors sought to generate cash immediately rather than putting money into businesses hoping for future returns. Inflation also contributed to the fall, as did the fact that advertising budgets were cut in response to recession fears, leading to the lower ad revenues for many tech companies. Additionally, the strengthening of the US dollar significantly impacted many major tech firms that rely on overseas business. How long will the slump go on? The impact of high interest rates will likely continue for quite some time. The Fed expects to continue raising rates through the end of 2023 and hold them steady until at least 2024. This indicates that tech businesses have at least 2 years of higher rates before they can expect some relief from the central bank. So should you buy tech stocks now? Investors who can handle volatility in their portfolio might consider investing in well-established tech companies during the downturn, hoping they'll recover as economy improves. Here are some of the best companies to look at. Amazon. According to their recent report, net sales increased 9% in 2022 compared with 2021. However, operating income decreased 50% to $12 billion in 2022 compared with 24 the year later. North America and international shipments faced losses, while only AWS showed income. Amazon also increased its investment by $10 billion last year to support its cloud computing business, which is traditionally its biggest profit driver. AWS segment sales increased 20% year over year, but the cloud business of their competitor Microsoft grew 22% over a similar time period, and Alphabet's cloud business increased 32% in the fourth quarter. So what are the prospects for Amazon? It's important to remember that Amazon is a leader in e-commerce and AWS already dominates the cloud industry and accounts for 34% of the total market, whereas Microsoft has only 21% and Alphabet only has 11%. These markets are forecast to grow in the double-digit percentages throughout this decade. Although Amazon does not seem like a fast gainer in the current economic conditions, as customers are cutting spendings, but so is Amazon. Transportation costs are coming down, which will contribute to better operating margins in the coming years. Third-party sellers accounted for 59% of total sales, and that number has been climbing. That's a low-cost source of revenue for Amazon. Advertising sales increased 23% over the last year, and that's a growing area with a lot of potential for the company. Today, Amazon shares are trading at 1.95 times sales, near their lowest point by that measure since 2016. This represents a huge opportunity to get in. And what about Apple? Apple reported that revenue fell 5% to $117 billion during the 3 months that ended in September, the company's first quarterly sales decline since 2016. Profits decreased 13% to $30 billion. Although Apple's CFO says the demand for new gadgets is expected to dampen in the coming year, an increasing proportion of Apple's revenues come from its services and subscriptions. In the December quarter, Apple's services revenue rose 6% year over year to $20 billion. Services include the App Store, iCloud, Apple TV Plus, and other offerings, you know them. It's important to note that amidst difficult economic conditions, Apple has beaten expectations 3 out of 4 times in the quarterly earnings announcements last year. And the next growth driver might be their headset for virtual reality and augmented reality that's been leaked in the news. Alphabet. Google's parent company reported revenue of $283 billion for the full year of 2022, which is up 10% in comparison to the previous year. However, Alphabet's revenue came in below expectations as its advertising revenue fell for only the second time in its history, partly because of the strengthening of the US dollar and comparisons with soaring growth a year before. YouTube advertising revenue fell 8% short of analyst expectations. And as you can see in their financial statement, everything except for Google Cloud showed worse performance in comparison to the previous year. There's no doubt that Alphabet, like any other businesses, is dealing with the weaker macro environment. Advertising costs are one of the first things businesses cut in hard times. But according to data provided by Statista, Alphabet commands a 28% share of the global digital advertising market that is expected to eclipse to $1 trillion by 2027. The company is also focused on AI. CEO Sundar Pichai said, "Very soon, people will be able to interact directly with our newest, most powerful language models as a companion to search, in experimental and innovative ways. Now is a good opportunity to buy Alphabet shares, because they are currently trading at a price-to-earnings ratio, or PE, of 17. This is substantially cheaper than the trailing 10-year PE of 29. And one last thing. Warren Buffett has recently bought 17,000 shares of Alphabet, but this is not an investment advice. And the last one, Meta. Meta, formerly known as Facebook, has reported negative results in Q4 and feels the weakest. You can have a look at their financial statement. In brackets means minus or losses. However, shares rose 20% that day because investors expected even worse results. So Marcus pleasantly surprised everyone. The company's user metrics were also quite solid. Daily active users of 2 billion, beating the estimate of 1.98 billion and up more than 70 million from a year prior. While the earnings were quite satisfactory, the main reason for the 20% growth in a day was the company's announcement of a whopping $40 billion stock buyback. As for its prospects, Zuckerberg said in Meta's Q4 call that one of his goals for the company is to become a leader in generative AI in addition to our leading work in recommendation AI. Although all eyes are on Google and Microsoft in their AI rivalry, Meta has long been a pioneer of AI. For example, Facebook was a pioneer in image recognition. Remember how you get notifications, "Is that you on the photo?" Or in 2022, the company launched the AI Research Supercluster, one of the fastest AI supercomputers in the world. Meta's scientists plan to eventually use the system to train AI models with trillions of parameters. By comparison, OpenAI's ChatGPT was trained on 175 billion parameters. Huge sets of training data are critical for improving AI systems. That could give Meta an advantage. The company's messenger applications combined are used by nearly 3 billion people on average every day. Few rivals can match the conversational data access that Meta has. Short term, the company is trying to restructure costs and become more efficient. There is no fast way to increase profits now and thus see dramatic stock growth. However, Mark introduced paid verification. Maybe it will help to bring in some cash to cover the costs of metaverse development. Long term, the prospects are vague too. Instagram sees rising competition from YouTube Shorts. WhatsApp is competing with Telegram, and AI technologies with Microsoft and Google. The only unique product is Metaverse, but it's far from being complete. So Meta looks like the riskiest stock in this bunch. One thing to consider is that tech isn't a single industry. It includes e-commerce, cybersecurity, social media, and dozens of other industries. For example, as more companies realize cybersecurity is essential for keeping their businesses safe, the cybersecurity industry could outperform other sectors, as it has outperformed the market in the past 5 years. To conclude, it may be a good time to buy big tech companies because their decline has more to do with bad macroeconomics rather than with them losing market shares or doing their jobs badly. They all continue to generate cash and can survive through protracted recession. We might even see consolidation on the market because richer and bigger players will buy out drained smaller startups. Buying smaller, unprofitable tech companies is more risky at the moment. If the Fed doesn't change direction, without cheap credit, many tech companies will struggle to survive. The trick is that we don't know how long it will take. So it's better to focus on stronger companies and buy them while they're cheap. Another approach is buying more specific sectors that are in demand despite market conditions, such as cybersecurity, AI, and cloud computing. You can buy them in one click in Gainy. Thanks for watching. Don't forget to subscribe to the Gainy channel.